Today is the FOMC meeting, and they will determine the federal funds rate or the interest rate, which governs a lot of financial products and instruments all over. And this information can generally move the market a lot. So the question is, what direction are things going to go depending on what information is released by the Feds? The consensus right now, according to the data from the analysts and professionals out there, the consensus is that the Feds will have a change of 25 basis points in the negative. All right, so they would lower the interest rates by 25 basis points, which means that the federal funds rate will be around 5% to 5.25%. Currently, it sits at 5.25 to 5.5%. Now, with that change in rate means that banks are able to lower the rates on things like your mortgage rates would go lower, which generally that is already priced in already. Credit card rates can generally be lower as well. We have just any loans will have to go lower. But on the flip side, even on the savings accounts and CD rates, and also your high yield savings accounts, those rates will also go lower, the APYs you get on them. And also, if you have seen my CD video that I made last week, I actually talked about how those rates are already priced in. That's why you would never see a CD that is higher than 6% nowadays, because the rates are already priced in due to the fact that the Feds will, or already mentioned, that likely going to reduce the current interest rates, the Fed fund rate. Now, with that information, we can do two things with this. We can either choose to take advantage of this or not do anything. You have to understand that inflation has come down a lot and is still going downwards. And hopefully, the plan is to still get it to around 2%, which is generally the target. But if things pick up again in terms of inflation, and for some reason the prices of goods and services starts to go up, well, that can make this high interest rate period stay higher for a long time. So if you have, say, for example, you have savings accounts, CDs, and also maybe even money in high yield savings accounts, then you need to pay attention to what rate you're getting, because if your money is not getting enough to at least beat inflation and grow, then you may want to consider moving some of that money into something that will provide more yields on your money. So whether that will be higher paying CDs, or maybe that will be investing in the stock market. It all depends on what works for you, of course. You have to be the judge of that. This is not financial advice, like they say. But you have to remember that your goal is to let your money work as hard as possible for you, so that you don't have to do as much work. And the benefit of your money working for you over the course of time with compound interest in your favor is that your money, if it makes higher interest on it or yields on it, you're able to make much more money over time, and that would benefit you in the long term. So the question is, what should we do right now? Well, we should, of course, pay attention to the interest rates that we are getting on those savings accounts, like I mentioned, the CDs, and also like the checking accounts that we hold, especially if you have a chunk of money in those type of accounts. Otherwise, pay attention to the stock market, buy the ETFs that are diversified, so that way you can actually you can invest in and make money through the returns of these ETFs. Generally speaking, the stock market will return around 8%, 7% per year in a good time, during the good times, and that's a great. And also, it can go as high as maybe 20%. That's something that you want to benefit from if you stay invested in the market. Otherwise, your money may just be in a savings account where you're not making the most out of your money because of the interest rates you're getting paid. This is something that I believe will benefit you if you take advantage of it. I'll see you in the next one.